Welcome to Keeping It Realty.
Welcome back to Keeping It Realty. I'm your host, Martha Smith.
And I'm your co-host, Natalia Pierantoni.
And today we've got a guest returning to the show
Yay.
to talk about yet another program. Please help us welcome
Heidi Lambordi with Pioneer Mortgage.
Thanks, guys.
Welcome back,
it's great
Heidi.
to be back. Thank you. Thanks for having me.
All right. Welcome back, Heidi. The last time you were here, you talked to us a little bit about the Hometown Heroes program.
Yes.
Today, we're bringing you back to talk about another subject.
Nice.
We appreciate you coming back because I know that it's a trip. You know, you have to come back, but you have so much to share. So we appreciate you.
Thank you. Thanks for having me. I'm excited. This is one of my favorite loans, so I'm super excited to talk about this today.
Oh, so
excited too.
tell our listeners what it's all about.
Yeah, so today we're going to be talking about rehab loans. And the main one that I would say most buyers use is the FHA one. It's called the 203K. So this one is near and dear to my heart for a couple of reasons. Number one, because I was like obsessed with HGTV, especially like after I had my kids and I was sort of in that downtime mode. I would watch HGTV all day. One of my favorite shows was Fixer Upper with Chip and Joanna Gaines. And so I was always like, oh my gosh, what a cool thing to take this house that is like a diamond in the rough and turn it into this gorgeous home. So I love this one because it kind of, number one, lets me live vicariously through others with my HGTV,
I love that.
Reality TV, aspirations, but also it's just a program that really lets buyers, they say with real estate, that old adage is like location, location, location. And, so if you're a buyer who wants to buy a house in a more in demand area or an area that's more convenient for you, sometimes it's really hard to find a house in your budget that is everything you want. Especially because a lot of those homes have been around a long time, right? A lot of these homes are like, if like, let's say you're buying in Tampa, if you want to buy in Ybor City area or downtown area or really Temple Terrace, almost any area. A lot of these houses have been around for, 50, 60, 70 years or longer. So what this loan lets you do is take that house and turn it into what you want it to be. And the hardest part about rehab for buyers is funds, liquidity, because it's expensive. So if you're a first-time home buyer and you have your down payment saved, you probably don't have $50,000, $100,000, $200,000 also to remodel a house. So it gives buyers this amazing chance to take a house in the location they want and turn it into the house that they want. Yeah.
Okay.
So it's an amazing loan.
I'm in. So tell us,
great.
like, how do we take advantage of this?
Okay, so this loan, so there's a couple of different types of rehab loans. So there's conventional and there's FHA. So we'll talk about the FHA one primarily, but just understand if you are a buyer who's shopping in a higher price point or maybe your credit profile is a little different, we also have them for conventional. Okay. So FHA's loan limit's a little bit lower than conventional and the credit guidelines are a little more lenient with FHA. So we'll primarily focus on FHA because I would say that's the majority of the rehab loans that I do is FHA.
Fair enough.
So let's say you found a house you love for $300,000, but the house is, looks like it was, your grandma lived in it. It's like, there's, wallpaper and there's, orange carpet or even maybe it's just not the layout your family needs. Maybe the house isn't super out of date or in a state of disrepair, but maybe it's not big enough or, it doesn't have the open concept or the office you want. So what you can do with this loan is you acquire the house for, let's say you get it for $300,000. You have a contractor go to the property, give you an estimate of what it's going to cost to make it what you want it to be. So let's say that is $150,000. So now you are at a total cost of $450,000. So we'll allow you to put 3.5% down of that $450,000, and then you can do that $150,000 worth of rehab and improvements on the house, roll it into your mortgage. So that allows you to, number one, be able to do it at all, but also have it at a super affordable interest rate and terms, because you got to keep in mind the cheapest money you're ever going to borrow is your primary home mortgage in any market. So, if you are, for example, putting it on a credit card, that's going to be a lot more expensive than putting it in your mortgage. So it's it's a fabulous opportunity. The other really cool thing about this loan, because I have
let me back up really
hon.
quick. So, but the house does have to appraise, right?
So
Because you can't buy a house that, let's say, is worth, you buy it for $300,000 and then you want to do $200,000 worth of renovations,
Yes.
but the house, even with the renovations, is only going to be worth $4,000. Am I correct? It would have to appraise for the amount,
with
or no?
the FHA rehab loan, you can go up to 110% of the appraised value.
Oh, nice.
And the appraiser will account for the improvements when they're valuing the home. So the appraiser knows what you're going to do to the home. So if you're adding to the home or just taking it from, this condition to another condition, adding a bathroom, whatever it
Okay.
is you're doing in the scope of that rehab, they're going to account for that when they value it. So it usually, I haven't had many with any appraisal issues.
Okay.
If we did have that come up, so let's say in that scenario I just described where it's 450, let's say it appraised at 390. Okay, so the maximum we could do for your loan would be 429, or for the amount that we would lend on. We would just make some minor adjustments maybe to things that aren't adding value to the property and remove those from the scope of the budget, or you could bring additional down payment to help cover that. So we'll usually find a way to make it work. The other really cool thing about this, so a lot of my first time home buyers come to me and they're like, hey Heidi, I want to have an income producing property. I want that house hack where somebody's paying my mortgage for me. Cause I do agree. That's a pretty cool hack.
Yeah.
So a lot of them want duplexes and duplexes.
Multifamilies, yep.
Yeah. And duplexes are a little hard to find, sometimes at a higher price point. So one of the things you can do with this mortgage is add an ADU, which is an accessory dwelling unit. So, a little unit in the back that you can rent out for rental income. So that's a really cool feature. So then let's say that adding that ADU costs $70,000, but you can rent it for $1,500 a month. Well, now you're having that person that might add $350 to your mortgage. So you're really netting, $1,150 that's helping to pay your mortgage. And we can use that income to help you qualify for the mortgage, which is even cooler. So
Whoa.
That's amazing.
So it's a really amazing loan that I feel is not used enough in our market. I think people either don't know about it or are a little scared. It's definitely a more involved loan, but if you work with the right people, the right contractors, the right lender, like me, for example, I do them so often that we know what's needed. We work with the contractor to get what's needed. And I've closed these loans in 3 weeks. I've closed them in 45 days. Mostly it depends on the contractor because we do need some paperwork from them. But again, we'll work with them. You can pick any contractor you want. They just have to be licensed.
Yeah, I was going to
insured.
say.
Yeah. So.
Who does the whole general contractor? Like you have to hire him and make sure that he's licensed. We had occasions where they're not, and it's just a whole mess. But
Yeah, so definitely, and that due diligence is done very early in the process. So let's say you take a buyer to a property, they love it. It's in the right location. It's got the yard they want. It's perfect for their dogs. They can put a swing set for their kid, whatever they're envisioning for their life in this house. But the house itself is not quite what they're looking for, but it's a perfect location, everything else they want. And you're like, okay, we can get it the way you want it. Then immediately, right after you put an offer in, you want to get a contractor out there to start working up the numbers, working on the bid. And, and again, it's sort of an iterative process. You might start off with a list of 50 things you want done to the house, and maybe because of payment or appraisal or whatever, you might scale it down a little bit, or you could add to it, but what the most important thing, and the appraisers know this and the contractors know this, whatever you tell us you're going to do, that's in that final appraisal, they're going to come back out later and make sure you did it. So you can do extra things. I have buyers who do self-work outside of the scope of the rehab, and that's totally fine. So you might say, hey, I want to put the kitchen in the rehab loan, but I'm also going to be replacing all the floors. That's fine. As the floors aren't on the bid, if you do them, great. If you change your mind, great. Just whatever's on that list, we just make sure it's done. But that doesn't mean that you can't do other things on your own as well. Because I have a lot of handy buyers that want to do things on their own.
Yeah.
This loan is not an open-ended credit line where you can do your own work. It's more contractor doing the work for you. So, just keep that in mind too. It's not the same thing as just, hey, I'm going to get $100,000 and do whatever I want with it. It's a more specific list of items that we have them do, which actually has turned out to benefit people a lot because we can kind of be I wouldn't say the bad guy, but but we hold your contractor accountable because they have to come to us for the money. And if they haven't met certain milestones with your work and your construction, they don't get it. So
I was going to say, can you walk us through the process? Like,
absolutely.
From start to finish?
Yeah. So you find the house, you get the bid from the contractor. The contractor works with the buyer to finalize those items. Depending on the scope of the rehab, so if you are doing more than $75,000 or you're making structural changes, you'll also talk to what's called a HUD consultant. And that's for conventional and FHA, both require that. And that is a specially trained person that's familiar with rehab loans, that works with contractors. Usually they're contractors themselves or former contractors. And they will help develop the plan between you and your contractor. And that would include things like materials needed, labor required, and also what we call the draw schedule. So the draw schedule says the contractor is going to get X dollars when this milestone's completed. When they might get 30% of the money at closing, and then they might get, another 20% when the kitchen is installed or the cabinets are installed, so we have different milestones that they're going to meet. So you do all of that up front with the contractor and a consultant if necessary.
Prior to closing.
Prior to closing.
Will this be already under contract or before? Like, how does that?
While you're under contract.
Under contract, right?
Yes,
Or no?
so while you're under contract. So if you're not sure about writing the offer because you don't know how much it's going to cost to do the work, then you would get a contractor to come out with you before or maybe during the inspection period. And then if something happens where it's too much, then you could cancel the contract. But it's really important to, get that contractor out there like as soon as possible. Yeah. So they can come out while you're looking at houses. I mean, most contractors aren't going to go to 50 houses with you or whatever, unless you're related to them maybe. But, so let's say once you find that perfect house, get the contractor out there, get the bid, we'll finalize everything. Then we close the loan. Okay. So we've done the appraisal. We have your finalized bid. It has it's a very detailed bid. It's going to have a list of all the materials, all the labor, everything involved with this project. And that gets turned over then to the rehab team at that point. So the loan is closed. You've gotten your keys. If there's a period of time where you can't live in the property, then we can defer the payments for a period of time as well. Nice. And that's something that we work with a HUD consultant to do. So those are only for the full scale renovations. Okay,
where would we get the contact information for that HUD consultant? Is that something that you would help the agents with?
Yes. Okay. So the HUD consultants have to be on a list approved by HUD.
Okay.
So there's a number of them in the area, and we've worked with a lot of them. So we can certainly help find the right one that for your personality or your needs. But so right after closing, then usually the contractor will get some sum of money. I would say on average, 30% of the money gets paid at closing. Okay. So they're going to get a chunk of money. They can use that money then to go buy the supplies and things you need for the remodel. Then they're going to work with you. The contractor will go to the property and start the work, permits, anything like that that's needed. And then once the work has reached a point where they want more money, we send the appraiser back to the property and an inspector back to the property to say, hey, okay, yes, you've done everything on the list that was required to get this next sum of money. And then they'll get that. Then we'll go ahead and award the next amount of money. So again, it's a little bit of a structured process, but what that does is it keeps that contractor on schedule and accountable to somebody else. So we can kind of be the bad guy who's calling the contractor saying like, hey, listen, you're not getting things done. Right. We've had a couple times where the contractors, flake out, or the contractor and the buyer just aren't feeling it with each other anymore. The love is lost there. And if that happens, we can sub a contractor out after closing. That has happened before. And that's a process we'll work with you, so we don't just drop the loan and run. I mean, we have a dedicated team that works with you through that post closing process to make sure that it's done. So all the repairs are done. We've met the draw schedules. The contractors completed the work. Then the appraiser goes out and does the final inspection that says, okay, yes, everything you said was going to be done is done. And then basically that part's wrapped up. So the number of times they have to go out, the number of inspections, the number of draws that are done really depend on the project and how much is being done in the project. And so, but that will all be agreed to by you, the buyer, the contractor, and the lender. We all have to agree to the schedule. So
prior to closing?
Yes, right. That's part of what we all agreed to prior to closing. So, so again, and I've had buyers use this loan. I've had, realtors want to use this loan. Let's say a house doesn't pass inspection. The roof can't pass inspection. The buyer loves the house. Everything else about the house is perfect, but the roof is old. The seller refuses to put it on. The buyer doesn't have the $20,000 to put a roof on the house. We can just do a roof with this loan as well. So, I mean, it doesn't have to be a grand
rehab.
Rehab. It can be very minimal, or it could be grand. I've had buyers use this loan to buy houses in an extreme state of disrepair that then they turn it into a beautiful home. So, when you buy a house, certain things about the house have to pass the inspection. Yeah. So let's say you buy a house that the electrical system's out of date. And normally the appraiser would say, and the insurance would say, we can't give you a loan on this house because of how old the system is. It's a risk, whatever. As long as that is included as part of the rehab, then we don't require the seller to fix it. The buyer doesn't have to fix it. So it really eliminates the need for repairs in a situation where the seller is unwilling, unable to make it, or even things that the buyer might need to do after closing that, again, especially first-time home buyers, I mean, it's hard to come up with the money to put down.
How does that work with insurance, though?
So we get a builder's, almost like a construction builder's risk type policy that then gets converted to a regular insurance policy after
in the
work's
meantime, I
completed.
guess.
Yeah, that makes sense.
As far as the inspections that you said they had to go back out, the buyer pays for that fee, or does that?
So that's all included in closing with your closing costs when you do the loan. So, with rehab loans, I would say the closing costs are typically going to be 1 to 1.5% higher, just with some of those rehab fees that come up. So with an FHA loan, the seller can pay up to 6% in closing costs. So if we're able to get the seller, when you guys negotiate the contract, if the seller's willing to pay a little bit more in closing costs, those will all be collected. Some of those fees can be financed into the mortgage as well. So, so usually the buyers don't have to come up with much more than in a regular loan because some of them can be financed. And if the ones that can't be, typically the sellers with the houses like that are usually willing to give a little bit more in closing costs. Yeah. So, but the buyer will not be paying for anything extra. But let's say we did the list and you said you wanted, and we have a contingency fund. Okay. So we hold back 10%, usually, sometimes 15. So if your rehab is $100,000, the estimate, we're going to finance 110. We're going to kind of hold on to an extra 10% because, sometimes things come up, materials might increase in cost. You might want to upgrade from a level 2 cabinet to a level 5 cabinet, or you might have thought you wanted Formica and now you want quartz or, whatever. So, so as long as the money's there in the contingency, we'll let you use it for some of those upgrades, or you can take the money out of your own pocket to upgrade things. They just can't go down from what the appraiser had. So you can't, if you said you're going to add 2 bathrooms, you can't just add 1. If you said that you're going to have quartz, you can't then decide, just put in Formica or something.
And so with that extra 10 or 15% that you guys hold back, let's say you don't use it, does that go back and drop the price of the loan?
Yes.
Okay.
Yes. We'll just give that back. We'll just lower the loan amount.
Okay. Good deal.
Yep.
So what kinds of homes or construction projects are not approved by this loan?
So the only, there's really not a lot. So with FHA, you can't use the loan to put a pool in,
I was going to ask.
a
can you do
swimming pool, but with conventional, you can. So you can put a pool in with a conventional. So if you are a buyer who's conventional, looking for a home, and the home has everything you want but does not have a pool, we can use this loan for a pool. So again, you don't have to put that money out of your own pocket. Pools are, really expensive. Yeah.
I know. I was going to say that's going to be an expensive pool because you're going to have the loan costs, for borrowing the money plus the pool.
Yes.
But you could do it if it's a conventional.
Well, so again, like if you were to get a private loan through the pool company, it's going to be a lot more monthly than if you roll it into a mortgage,
true,
because the pool companies usually are more like car loans where it's maybe 10 years, maybe 7 years, and they make you put down quite a bit. They're a little more sensitive with your credit. So let's say you financed $100,000 pool. Let's say you finance $80,000 worth of a pool with a pool company. I mean, you're probably going to be paying $1,500 a month or more for that pool. Where if you do it in your mortgage, putting an extra $100,000 and you maybe are going to pay $500 a month difference, maybe $450.
It's a big difference.
Yeah, so it's a big difference. Yeah, and just liquidity wise for the buyers, cash is always, I don't want to say always because there are exceptions, but I would say with the buyers, mostly what I see is, liquidity, especially for first-time home buyers, is their most limiting factor. So when they're looking at a house and they're like, gosh, I don't have $25,000 to do what I need to do to this house, so I'm going to pass on it. I just want people to understand, you don't have to pass on that house. You can actually spend the $25,000, and plus you can get the extra stuff you wanted to. If you want to, you could do $40,000 and add a wine fridge or whatever it is that will make the house exactly how you want it. So it's a great opportunity for buyers.
That's why I was so excited to bring you back, because a lot of people don't even know that this is an option. I'm thinking in the top of my head, so many people that could benefit from this, aren't you? I know you are, because people always want a house, like you said, in this area that's super overpriced, and maybe you could find this house that needs a little bit of work,
right?
That you can afford. So this is
wonder
great.
you're so excited about
We're
this
just getting
program.
inspection issues through. Yeah, well, and in my head, as we're talking, I'm literally playing episodes of Fixer Upper in my head. I'm imagining the big pullback and So it's a pretty cool. You guys have to buy the giant screens and open them up like that,
little scissors with a ribbon. Here you go.
Exactly.
Is there anything else that we missed on this program? Obviously.
Not really. So credit, so the great thing about this program is that, you can have a 580 and do a rehab loan. So you can? Yes. So you don't have to have great credit. You don't, you just have to meet basic FHA guidelines.
Okay.
There's not a lot of overlays with rehab loans. They're a little bit higher risk. So, sometimes a buyer that was not going to use rehab that decides to, sometimes we might have to make a few adjustments in the loan. But for the most part, it's pretty standard that if you were able to get an FHA mortgage, you can most likely also do a rehab. We just have to account for the additional costs. The other thing that's really cool, let's say you bought a house and you paid $300,000 for it and you did $75,000 worth of work to it, but you didn't add on to the property. So you didn't have to go to the county. You didn't have to do any of that stuff. The county is going to base your taxes on what you paid for that house. They're going to be basing it on $300,000, where it probably less, but worst case $300,000. If you buy the house that's already fixed up down the street that's listed for $400,000, the county's going to know you paid $400,000 for that house. So in addition to just being able to make it exactly what you want, you actually get some benefits with property taxes and stuff too. So, so it's that's just something else to kind of consider, is that, it does make your acquisition price because the county just knows what you paid with the sales price. Yeah. So if you have to get permits, they will assess the improvements in addition to what you paid for it. So let's say you paid $300,000 for the house and then you add a bathroom, and adding a bathroom adds $50,000 in value per their little, metric or whatever they use at the county. and I don't even think it's that much, but let's say it's 25,000, then, they're going to be now saying, okay, that's 325. So, but still less than the 400,000 for the person paid down the street. So
yeah, so there's a tax.
So there's also like a
there.
property tax benefit, because your property taxes are pretty much forever the whole time you own the home.
They just keep going up.
Keep going. They just stay there. Unfortunately, they don't go away. But so that baseline tax amount is really important for buyers. Like, you want to kind of lock in the lowest baseline you can. And so if you can get that baseline lower because your sales price is lower, and then you rehab, that's just an additional benefit.
Yeah.
Yeah.
Good stuff.
Yeah, so it's a super cool loan.
Do you have any questions for her on this loan?
I do not.
No? Does she answer everything?
I think so, yeah.
Yeah?
You think so?
You did an
Okay.
amazing job.
I know. You explained it so well. I'm excited to use it.
Yes. So
okay.
it wouldn't be Keeping It Realty without a rapid fire
right.
game.
Oh,
yeah,
boy.
so
Okay.
But last time you were here, we did a little rapid fire. This one is going to be a little different.
Okay.
This one is going to be a take it or leave it.
yes.
Okay.
So I'll start. You get a return client, but it's a nightmare client. Do you take it or leave it?
Oh, take it.
I knew you'd say take it.
Someone else denied a loan. The buyer comes to you. Do you?
Take it. I do a lot of loans that other people can't figure out. So I definitely would take that. Yes.
Okay, so you are on vacation and you get a work email. Do you take it or leave it?
I mean, as long as I have service, I would take it. Yeah. I would answer it.
Hope you're on a cruise way, way far in the sea.
Yes. If I'm on a
Couldn't get
cruise,
to you.
yeah. If I'm on a cruise, somebody else will be answering my emails for me.
You get a work call about a condition on a loan while at the gym. Take it or leave it?
Well, unless I'm in intense cardio, I'm taking it.
Yeah.
As long as I can talk.
Can you
And even then, hello, hold on. And it depends also, I guess, on the, like how hard the underwriter is. But yeah, I would say probably I'd take it. Yeah.
Oh, you take it. Okay, last one. The client can only speak to you after 9 p.m. Do you take it or leave it?
Oh gosh. Well, as long as they don't mind me being sometimes a little happy, I'll take it. Yeah. As long as I don't have to testify in court.
Yeah.
So what we talked
I'd be like,
about. I'll
let me
take
write
it.
this
No,
down.
Just kidding. The nighttime people I don't mind. I will say I leave texts after probably 10 o'clock because I just find, and I'll answer them in the morning. Not that I don't see them, but I just find then that it, like, you know how it is. Like,
Yeah.
then they want to text you all night.
Yeah.
And you have to have some
Boundaries.
You do. You have to set boundaries. I agree
some
with that.
clients like text and calls us.
No,
I
I've
was
had
like, dude, I'm
a
sleeping.
client call me at 2 something in the morning, and I was sleeping. They were like in Vegas. I'm like, I'm in Florida, dude. I was sleeping.
You're not near the time zone?
Yeah, that's So I mean, so I would say take it, but with an asterisk,
caution.
Like
Is this an emergency?
Depends. If it's 9:30, yes. If it's 11:30, no.
Got it. Okay.
I would leave that.
Well, Heidi, thank
the
you
morning.
so much for coming back to the
Sure,
show
yeah,
and giving
thanks
us
for
all the
having me.
tea about the construction loans.
If you have any questions or want to learn more about the program, you could email us at keepingitrealty@gmail.com.
And if you know anyone that would benefit from this episode, please share it with them.
See you next time on Keeping It Realty.
Thank you all for tuning into our podcast. And I hope you guys enjoyed it as much as we did.
Don't forget to follow us on social media at keepingitreal_T and share this episode with all your friends.
If you guys have any questions and topics that you guys would like for us for future episodes, let us know. Shoot us a message. We would love to hear from you guys.
See you next time on Keeping It Realty.